In this section, we're going to do a full worked example. We've got a company called Boscombe Limited. They sell ice creams, and we're going to see what transactions they do and how those transactions fit primarily into the balance sheet, but then we will look at the income statement and cash flow statement as well. By the end of this section, hopefully we will have built up a understanding of the links between the three statements, and you'll see at the end that they do all tie together. So we begin with the setup. Boscombe Limited is a startup company selling beach toys and ice creams. We have 8 transactions, and for each of these I'm going to want you to pause this and choose where you think it goes. There's plenty of space for writing and for scribbling. Have a go at each of these and we will talk through each of them as we go. So we issue some shares, we borrow some money, purchase an ice cream dispenser, buy some inventory, sell some inventory, pay a shop assistant, pay the inventory supplier, and then pay the bank some interest. So those are our transactions. So we're going to focus, as I said, on the balance sheet initially. Here we have the setup. It's a fairly simplified balance sheet. You can see the left half of the balance sheet, or in this case the top half, is just cash, receivables, inventories, and property, plant, and equipment. The right half of the balance sheet, liabilities and equity, are payables, which are short-term, long-term debt, common stock, and retained earnings. And we're going to do this transaction by transaction. So when it says transaction 1 on the slide, on the screen, think of that as what numbers we're putting into our little box diagram. And then the balance sheet is going to be cumulative. So each time we do a transaction, the balance sheet will accumulate all the transactions to date. So let's have a go at this. So transaction 1, Boscombe issues 1,000 £1 shares at par. Now, we haven't really talked about par much on share capital, but each share has this notional par amount. For the time being, it's not going to affect anything we do here, but we have common stock shares being sold, £1,000 of these, because it's 1,000 shares at £1 each. So how are we going to do this? Think to yourself, so press pause now and try and work out where you're going to put the numbers, what numbers are going to go where, and make sure that the transaction is balancing on the left and right, on the top half and the bottom half. Have a go at that now. Hopefully you have got the fact that it says common stock, so common stock of 1,000 comes in. So we've raised £1,000, we've issued £1,000 of shares. Why have we issued £1,000 of shares? Because we wanted to generate some cash, and therefore cash comes in of £1,000. That then gives us a total balance sheet so far of 1,000, nothing, nothing, nothing. Total assets 1,000, nothing down here, but 1,000 common stock, total 1,000. So in other words, we have total assets of 1,000 and total liabilities of an equity of 1,000. So fairly simple so far. So that's the first transaction. There you can see the first transaction written in, just to confirm that we got it right. Second transaction, Boscombe borrows £500 from the bank. So press pause and have a go at that one now as well. What do we have? £500 from the bank. Hopefully you're saying, well, the bank, this is a long-term borrowing. It doesn't say it's long-term, but let's assume it is. It's the only place it can go on the liabilities side. We've borrowed from the bank, we're going to have to repay it, so it falls under the definition of liability. And long-term debt is going to be plus 500. Long-term debt is going to be plus 500. What's the flip side of that? So just think we've got an increased liability. Something has to make it balance, either an increased asset or a decreased liability or equity to offset it. In this case, the reason you borrow from the bank is because you want the cash. So we put in plus 500 on cash. Total balance sheet to date, we now have 1,500 cash. Nothing, nothing, nothing. 1,500 total assets. Nothing. We've got 500 debt. We've got 1,000 common stock, and that all adds up to 1,500. So you can see it all balances nicely. Fairly simple so far. We've issued some shares, we've issued some bonds. We've got total cash in the bank of 1,500, debt of 500, common stock 1,000, and so that all balances. And there you can see transaction 2 and the balance sheet to date shown on your screen. Transaction 3, an ice cream dispenser is purchased for £320, paid in full. So where does this go? Press pause and have a go. So we're buying an ice cream dispenser, we're buying an asset. What's the asset? Now, it's not inventories, because inventories are what you're buying in order to sell. Here, it's property, plant and equipment. It says an ice cream dispenser, that's going to be a form of equipment, and therefore, transaction 3, we're going to have PP&E plus 320 under PP&E. We're paying for it in full, therefore, it's going to be cash. So cash goes from the bank. Cash minus 320. And there's the transaction, as you can see. Balance sheet to date now, 1,500 in the bank minus 320 is 1,180. No receivables, no inventory yet, 320 of PP&E. Total assets, 1,500. So in fact, that hasn't changed. On the liabilities and equity side, we've still got 500, debt 1,000, common stock, and total 1,500. So there's our balance sheet. There's our balance sheet, 1,500 assets, 1,500 liabilities and equity. You can see that now shown on the balance sheet under balance sheet 3. Let's have a go at transaction 4. Inventory of £400 is bought on credit. Have a go at that. Now, hopefully, you've realized we're not paying cash for this, so cash is not affected. We're buying inventory, so inventory is going to go up by 400. There's our inventory. We've bought it on credit, so we haven't yet paid for it. What do we do with that? Where does that go? We haven't borrowed the money, but we owe our supplier money, and that goes into accounts payable. So accounts payable is plus 400. And that's our transaction 4. So inventories went up by 400, accounts payable went up by 400, we owe our suppliers some money. So the balance sheet, cash hasn't been affected, so 1,180. Nothing, we have no receivables, we've got inventory of 400, PP&E of 320, total assets are now, well, they've gone up by 400, so it's now 1,900. On the liability side, we've got 400 payables, 500 debt, 1,000 equity, total, no retained earnings, total 1,900. So the balance sheet still balances, and you can see that, in fact, it's grown a bit by buying some inventory on credit. We've actually increased the total assets and increased the liabilities and equity. So there's our balance sheet number 4. Moving on to number 5, you can now see number 4 confirmed to us there. Number 5, a quarter of the inventory is sold for £250 in cash. This is a bit trickier. Hopefully you've got a feel for how we're going to be doing this and how this diagram works, so how we're going to use our Quartic matchstick diagram. Have a go at transaction 5 and think carefully what goes where. Don't forget it has to balance, so have a go at that now. Now, the first thing to do, let's try and work out what we can put in here. So transaction 5, we're selling a quarter of the inventory for £250 in cash. So let's just do what's easy. Cash goes up by 250. So cash has gone up by 250. What next? A quarter of the inventory. Now think about this. How much inventory do we have? We have 400 of inventory. A quarter of that is 100. So we are getting rid of 100 of the inventory. That's reducing from 400. That's going to go down by a quarter, which is 100, and it's going to leave us with 300 inventory. Now, that doesn't balance. What's left on that? Now, remember what I said earlier. If you're in doubt as to where to put a number or you can't see how to balance it, always think, does it affect the income statement or the profit and loss, the P&L? Answer in this case, well, we've sold some inventory. We've sold £100 worth of ice cream for £250. That's a profit. How much profit? well, £150. If you buy some ice cream for £100 and sell it for 250, then you've made 150 profit. Where does that go? Well, it's gross profit in the income statement, and it feeds through, therefore, to the balance sheet under retained earnings. So we've made this 150 profit down here, and that all balances. Let's fill the numbers in. So balance sheet 5, 180 plus 250 goes up to 1430. Still no receivables. We're down to 300 inventory, 320 PP&E still. And so now you can see that's 1750, that's 2050. So the balance sheet's grown even further. We've made 150 profit. You can see assets have gone up by 150. Accounts payable remain at 400. Long-term debt remains at 500. Equity or common stock remains at 1,000, but now we have retained earnings also in equity, which is now 150. And add those up, that comes to 2050. So there's our balance sheet after transaction number 5. You can see, hopefully, that all balances nicely, and make sure that's familiar. So that's the hardest one so far. We've got a bit of profit here. That's going to affect the income statement. Make sure you understand how the cash went up, the inventory went down, and the difference was going to be profit. It's profit, which goes into retained earnings. Transaction number 6. A shop assistant is paid £100. So what happens here? First of all, think about what the objective side of this is, and then think where we put the other half. So have a go. The objective side, hopefully you can see, is cash. We're paying £100 cash to our shop assistant. Now, what's the other side of that? It doesn't affect receivables or inventories or PP&E. It doesn't affect payables because our shop assistant is not a supplier. What it affects is the income statement. So this is a cost we have incurred. We've incurred costs because our shop assistant needs paying, and therefore it comes out of the income statement or retained earnings. So retained earnings down 100, and it all balances. So balance sheet now is 1330, no receivables, 300, 320, add that lot up, it comes to 1950. So we've gone down by 100. 1330 plus 300 plus 320 is 1950. On the liability side, we have still 400. Payables, we have 500 debt, we have 1,000 common stock, but now our retained earnings have dropped from 150 down to just 50. And that adds up to 1950 as well. So 400 and 500 and 1,000 and 50 is 1950. There's your balance sheet number 6. Number 7, the inventory supplier is paid. Have a try for that one. The inventory supplier is paid. So we owe our supplier how much? Accounts payable is 400. So we're going to be paying the supplier £400. So cash minus 400. And what we're doing is we're getting rid of the liability. We owe the supplier 400. That's being paid, and so it goes down 400 down to 0. So now the balance sheet is 930 cash, no receivables, 300, 320. That now adds up to 1550. You can see total assets have fallen by that 400 cash. Accounts payable are now down to 0. Long-term debt remains at 500. Common stock remains at 1,000. Retained earnings, what's happened there? What's happened there? Well, by paying off the amount we owed, hasn't cost us anything. Yes, there's a cash flow, but there's no expense involved. Yeah, the expense is effectively part of COGS. When we sell the ice cream, that's part of COGS. But there's no expense. We owe someone money, we're paying them. Cash goes down, payables go down as an equivalent. There's no movement in the income statement by paying some money that we owe. And therefore, retained earnings stays at 50, and there's your 1550 to balance. There we go, we're nearly there. That's number 7. Finally, bank interest of £10 is paid. So we're paying £10 of interest. work this one out. And there's a slight trick. Some of you may be toying with a couple of options here. So see what you make of this one. So we're paying bank interest. First of all, it's cash. So there's our 10 going. We're paying interest of £10. Now, what's happening? First of all, there's no impact on receivables inventory of PP&E, so it doesn't affect any other asset. Where does that £10, do we owe that £10? How has it been incurred? Now, although we're paying it to the bank, and it's the bank that we have this £500 long-term debt with, it's not affecting the £500. Now, a common mistake here is to reduce the 500 to 490. We're not doing that. And the reason we're not doing that is because we owed the bank we borrowed 500, we owe them 500. This is interest. So the 500 accrued £10 interest, which we're now paying, and that is an accrued expense. So the answer is going to be the income statement. But once you've paid the interest, you still owe 500. We're not paying any principal. We're just paying the interest. And therefore, it comes from retained earnings because it was an expense in the income statement. And that gives us our final balance sheet. So make sure you understand that last one. We haven't affected the long-term debt. It's an expense caused by the long-term debt, but the long-term debt remains as it was at the start. So how much cash do we have now? 920. No receivables. I mean, this is a retail business. Think about your local supermarket or retail outlet. They're not going to have many receivables because if you pay to a shop in cash, they've got the money. If you pay to the shop on a card, they're going to have the money within a few days. So there's accounts receivable are going to be very low for any retail business. Inventories remain at 300. PP&E remains at 320. Add that up, that's 1540. So just 10 down on before. Payables are 0. Debt is 500. Common stock is 1,000 and our retained earnings is 40. Add those up, that comes to 1540. So that is our final balance sheet. Let's now confirm. There you can see the final balance sheet. Hopefully that's roughly what I wrote down just before. And you can see that transaction 8 takes us to our finished balance sheet. Now, what I need to do is we need to integrate this now with the income statement and cash flow statement. So let's now look at the other two statements. Now, on the income statement, not many of the transactions affected it. If you issue shares, that doesn't affect the income statement. When you pay your supplier, that didn't affect the income statement. In fact, only 3 transactions did. First of all, we sold some of the ice cream, and you can see here revenues of 250. We sold £100 of ice cream for £250. So revenues 250, COGS of 100. So at the moment, that's giving us £150 of profit. Then we had our shop assistant that needed paying, and we paid them £100, and so there, transaction 6, £100 comes out. It's an operating expense. And then transaction 8 was the interest. Again, we've described that is an accrued expense because of the debt, and that brings the net income down to just 40. Now, no other transaction affects the income statement. If you like, it's only when you're doing a transaction that involves retained earnings that anything on the income statement's happening. Now, that's not entirely true. For example, let's say you buy or sell, let's say you sell something at 0 profit. That's not going to affect retained earnings, but it does affect the income statement. But for the most part, these are the 3 transactions where the retained earnings were affected. And you can see that this makes up our income statement. So we've got 250 revenues, 100 COGS, that's gross profit 150. The operating expenses of 100 for the shop assistant takes us down to 50 earnings before interest and tax. £10 interest takes it down to 40 earnings before tax. We didn't have to worry about tax, thankfully, which leaves us with 40 net income. What about the cash flow statement? Well, most transactions affected the cash flow statement. So transaction 1, so think about what we're doing here. 1, we issued shares, that's CFF, positive CFF. Transaction 2, we borrowed money from the bank. That's also positive CFF. Transaction 3, we bought some equipment. That was CFI. It's an investing cash flow. Transaction 4, we bought some ice cream on credit. There's no cash flow going on there. So we buy some goods, we buy some inventory on credit. Think what's happening in the bank account? Nothing. Transaction 5, we do make some sales, and there you can see the cash coming in. It's now an operating cash flow. 6, we're paying our shop assistant. Again, it's an operations, it's wages and salaries. 7, we are now paying our supplier. Again, it's inventory, cash paid to supplier as a standard operating cash flow. And then interest, this is where there was a possible difference between US GAAP and IFRS. Let's treat it as CFO to keep life simple, certainly under US GAAP, and therefore our interest expense is CFO. And you can see there that our total CFO, 250 minus 100 minus 400 minus 10, gives us minus 260. CFI is just the machine of minus 320. CFF is 1,500 that we have received in as an investment. Now add those three up, you get to 920, and given that we started with 0 cash and we ended with 920, you can see it has reconciled. Now, it's a simplistic example. For most businesses, if we take this further forward, you would expect CFO to go positive. Most businesses should have a positive CFO, positive operations, otherwise you're probably doing the wrong thing. Because if you're not generating cash from operations, then you need to generate it from somewhere. CFI is very often negative. The majority of businesses think what CFI is. You're buying new machines and you're selling old machines for scrap. In a typical transaction, if you sell a machine for scrap, you're going to get in relatively little for it. You may not get anything in, you may have to take someone to take the scrap away. Whereas buying a new machine, of course, it's an outflow, it's a negative CFI. So CFI is, for most businesses, is negative. CFO, for most businesses, is positive. And then CFF is whatever you need to make up the gap. And so there's our cash flow statement.